Hey folks, I'm Chris Shank and I'm your mortgage advocate. In this video, we're going to discuss two things that's on everyone's minds lately. We're talking mortgage rates and the stock market. The first thing that I tell all real estate investors, whether you're investing in your own home or a rental, is to follow the dollar. Let's say that earlier today, you found out that you had another rich aunt that you never knew about. Also, this aunt must have liked you because she left you $1 million. Let's say, in this example, that you resist the temptation to go buy a sports car or a trip to Disney and instead decide to make that money work for you through smart investing. Now, here's the big question. How are you going to actually invest this money? The art of predicting the performance of a specific business, sector of the market, or market itself is called speculation. Now, to really delve into what all goes down during the speculation process would heavily distract from the intent of this particular episode. Instead, we're going to continue our example. So you have that money and you're in the lobby of your financial advisor and you stumble across a series of news articles about how a group of scientists had synthesized a wonder drug from bananas that cures cancer and male pattern baldness. From this information, you're fairly convinced that anyone who has anything to do with this drug or its production chain stands to make a lot of money. You speculate that you could make a portion of that money too if you invest in that particular drug company. You further speculate that you could also make a fair bit of money by investing with the company that grows the bananas, the company that handles their transport, or even companies who produce male hair care products. Your mindset, you march into your meeting with your financial advisor and share with him your plans to make millions with your thorough banana-themed research. Your advisor is less than impressed and then proceeds to fill your mind with doubt about this particular course of action, instead proposing a series of less risky investments in savings bonds. Congratulations, you just went for a wild ride on the speculation coaster. It doesn't matter if that miracle drug really was a world changer or if it was simply a tropical scented blob of failure. What mattered is that you invested your money into a vehicle that you, or at least the person you trust to handle your money, believes will bring you the most return on your investment. This is, in a nutshell, how speculative investing works. Boiled down, it's at best an educated guess whether an investment will perform well or tank in a complicated web of political and economic factors. Now, are you ready for a confusing bit of information? The stock market does not have a direct impact on mortgage rates. That is, there is no set stock or even set of stocks that will directly impact mortgage rates. That said, a savvy investor can use the stock market to make an educated guess about where rates could head in the near future. Again, it's all about following the dollar. In our example, your financial advisor had suggested that rather than invest in a risky breakthrough medicine, you should instead invest in lower risk bonds. As we learned in our last video, bonds and other similar securities are often viewed as low risk because the assets or organizations supporting them are unlikely to fold. For example, a treasury bond is a low risk investment that pays you interest every 6 months until the bond comes due, at which point the government is obligated to pay you back your full principal. Where investments in the banana drug company could go belly up if that company declares bankruptcy. The only way for your treasury bond to fail would be if the US government were to go broke. As it turns out, people like it when their investments grow. They also tend to get quite upset if their investments look to be underperforming. When the stock market is doing well, more people feel comfortable investing in stocks over bonds and securities because the risks usually inherent to trading in volatile stocks are offset by the general performance of the market. When the market experiences a downturn, however, investors are more likely to pull their investments out of the stock market and instead invest in the safety of bonds and securities. The benchmark long-term security is the 10-year Treasury bond. An uncertain economy will oftentimes push the demand for structured investment vehicles, which means that when the stock market falls, the rates for Treasury bonds will likely increase. In order to compete with these rising rates, other securities will need to raise their rates as well. Think of it like this. If you were going to invest $1 million with a company who would pay you 6% interest year over year, or one who would pay you 7% interest, you'd probably choose the latter as they'll simply pay you more. Here's the thing though. Mortgage-backed securities are a form of long-term investment vehicle that also competes with treasury bonds. As bond rates increase, lenders are forced to increase their mortgage rates to ensure that the loans they write can be traded competitively on the secondary market. On the other hand, when the market rebounds and investors pull their money from bonds, the rates on bonds will decrease, which will allow lenders to cut their own rates to incentivize clients to do business with them. Because of the cyclic nature of investors and our economy, a good rule of thumb is to expect higher mortgage interest rates when the stock market is in a period of turmoil or extended decline. Conversely, you can also expect mortgage rates to drop if the stock market performs well. Now, before I leave you, I wish to impart a bit of wisdom that I've picked up as a loan officer. Don't blind yourself to the forest for the trees. On a $300,000 loan, the cost per month difference between a 6% loan and a 6.5% loan is less than $100. 2 years ago, a good friend of mine put his house purchase on hold because he heard that rates had increased 0.25%. A few weeks later, the rates had dropped back down, but he became obsessed with watching the market to predict the optimum time to purchase his house. He still hasn't purchased a house and has pumped around $50,000 into the house that he's renting. In that same time period, I've paid extra against the principal of my own home loan and now have about $20,000 of equity built up. Additionally, if the county assessors are to be believed, I've got about $70,000 of extra value in my property simply because of how my house has appreciated in value since 2022. Following rates can be cool, but don't laser focus yourself to the point of missing out on good opportunities. Regardless, if you follow the dollar, you're likely to learn something cool. If you learn something cool, you're likely to make better financial decisions pertaining to the largest investment of your life. This is Chris Shank with Mortgage Advocacy. Thanks for joining me today as we delved into the world of mortgage rates and the stock market.